On this hot sheet, I discuss housing inventory and homeowner insurance hikes. Today is Monday, July 31st, 2023. I am Byron Lazine, and the hot sheet starts now. Welcome back to the hot sheet. If you're returning, if you're in the live chat, let me know which market you're tuning in live from. If it's your first time on the hot sheet, hit the thumbs up and definitely consider subscribing so you don't miss this in the future. As we do every Monday, we're going to jump into the housing inventory and take a look at what it's been over the last 7 days, according to Altos Research. Okay, weekly active listings rose by only 4,988. That's seemingly what we continue to hear, the word only, as it relates to active listings. If we just take a look, and I've got these down below in the daily download for you in BAMX, so you can grab all of it. I've got 6 slides today. Weekly inventory rose about 5,000 from 479,000 plus to almost 485,000. That's well off where we were same week last year when inventory rose to 538,900, basically 539,000. We're, what do you call that? 55,000 active listings, give or take 1,000 here, apart from where we were last year on the active listing inventory count. Active listings in 2015, a more normal market, were well over 1.2. It was 1,207,000, almost 207,500. You can see here on the chart how much lower we are than last year, which is shocking to seeing where we were in inventory the last couple of years that were actually lower than where we were last year. Okay. Certainly way lower than any time before the pandemic as well. And if you look at the inventory here year over year, obviously continuing to be negative. We are starting to increase, but we're not having that seasonality push. Even the push that we had in 2021, certainly not the skyrocketing push we saw last year after interest rates. Last year we were coming from really nothing inventory to start the year. We started the year much higher, but we've just really been flat. I mean, look at this. This is basically flat from where we started the year. We had that seasonality dip in the spring, and now we're kind of back up to where we started the year. Unlike what you saw in 2021 and 2022, where we really had a significant steeper increase this time of year. We'll see if we can get there in August and September. Today is the last day of July, so maybe August will be better than July was. New listings, we're trending at all-time low for the new listings. There's a piece in Bloomberg today that, it's like maybe the 100th piece that's written on this, that people don't want to move because they've got such an asset in their low interest rate. And this is the truth. This is what, bringing interest rates up to a restrictive place like they are right now at a really rapid pace. This is what it does when you've got 90%, according to Redfin, over 9 out of 10 homeowners right now have a 30-year fixed rate under 6%. Okay, so Morningstar came out with this the last couple of weeks. Now Redfin has their numbers. More than 9 out of 10 homeowners have a 30-year fixed under 6%. These are the ramifications of that we're just not going to see a lot of listings, and this is going to continue here as we go through the year. This is going to be an extension going forward. There's not many signs that we're just going to get a whole ton of inventory. We're building more homes, single family homes, but we're not actually getting enough of them to make a difference. We're getting plenty of apartments, and not to sound conspiratorial, but like, why are there so many apartments? Why do we want people, renting instead of owning, right? We've got all these, I've shown the chart a bunch of times. We've got more apartments being built right now than at any point since the 70s. Why is it so important for us to get apartments? Jerome Powell was so proud that we've got more supply coming on, and I'm figuring he's talking about apartments because he's certainly not talking about homes. Well, why is he so proud about that? Why is he so proud about pushing more people into a position where they have to rent? Because the lower the supply we have on housing that you can purchase, the more unaffordable it gets. And it's going to continue to get unaffordable and here's the Bloomberg piece before I go to that. I mean, here's just that headline I'm talking about today. I mean, you're going to see more and more headlines like this. You just keep seeing them. Lots of U.S. homeowners want to move. They just have nowhere to go. Okay. They don't have inventory and they don't have a desire to leave a 2.75. That's kind of just the problem there. But we're going to continue to see issues with affordability, especially if we see issues in what it costs to maintain a home. Not only do we not have the supply, but once you get the house, you've got to maintain it with property taxes and, of course, insurance. In the Wall Street Journal, home insurers are charging more and insuring less. Double-digit premium hikes, higher deductibles, new coverage limits, drones to check the state of roofs and yards. Some insurers are insuring less and charging more as they try to claw their way back to profitability after losing money. We know insurance companies are not going to lose money for long. They're going to get that money back. If you're in a state like Florida or a state like California, you know the issues with insurance right now. Florida, in California, both states, you have big reputable insurance companies leaving the state, meaning we won't write policy in this state. They're making decisions not to write there. You also, at the same time, have more Americans moving into higher prone areas, higher prone flood or higher prone wildfire or wind in certain areas or tornado areas. You just have Americans migrating into positions where you can have some more issues, right? Well, why didn't we have all these issues 30 years ago? Yeah, the weather's different, but you also have a lot more people living in the path of a hurricane than you did 30 years ago. I think about Naples, Florida, where I own a home, and 30 years ago there was like nothing. They talk, and now there's a booming town, but it's right on the shore. So obviously it's in the path of potential hurricanes. All right, I've got a couple charts here from Wall Street Journal that'll drop below. Home insurance rate increases approved since January of 2022. Okay, you've got double digits in places like Florida, okay, between 10 and 15% increases on homeowner insurance. Alabama, all these, lighter pink states, this is 10 to 15% increases. I mean, there's tons of them. You even got Massachusetts and Rhode Island up there in the Northeast. There's a ton of those. If you go to that darker pink, you've got increases between 15 and 20% on home insurance rates since January 2022. Louisiana, Oklahoma, New Mexico, Nebraska, South Dakota, all on the list between 15 and 20%. And then you go up over 20%, sometimes 30%. That's Texas, Illinois, North Carolina, Arizona, Utah, Oregon. Those are well into. And then, between 5 and 10%, you've got California on that list, Georgia, South Carolina. Those could be going up, right? We know that there are insurers leaving. New York's on that list. Maine's on that list. Looks like Connecticut's on that list. Washington, North Dakota. The only one that's seemingly doing okay on insurance premiums is Wyoming. So maybe looking to save money on insurance, Wyoming would be the place to go. But as more insurers make decisions to maybe not insure in certain states, those prices obviously go up because there's not a lot of competition, just like what's happening with housing. Going back to the piece here in Wall Street Journal, Travelers, which is obviously huge, and you see them on commercials all the time. They said last week that a 19% increase in premiums was just one prong of its profit improvement effort. Beyond that, we're managing terms and conditions, the head of Travelers said with investors. Think deductibles, think age of roof eligibility, think coverage levels on roof emplacement. All right, so that actually makes sense to me, okay? If your roof is 25 years old, 29 years old, and it's a 30-year life expectancy, and then a storm comes and wipes it out, have you ever heard anybody being like, "Oh man, my roof was shot, and then storm came, and now I got a whole brand new roof," and they're like proud of scamming insurance there to some degree. They're like, and this is why insurance premiums are so high, because there are people that take advantage of the system, and then there are people that don't, and the people that don't, obviously are paying elevated costs for the people that are. Okay, but if you ever heard of somebody, had a storm, tore apart my roof, and then, I got a brand new roof. They're all proud of it. Well, they're not gonna let you do that anymore, right? That's why they got the drone technology. Okay, well, this is 20 years old. You're gonna get maybe a third, 30-year life expectancy. Something happens to your roof, you're gonna get a third of the cost, because in 10 years you're about to do that roof anyways. Don't know if you agree or disagree with that. Um, but that certainly kind of makes sense mathematically to me. Jody in OKC, Oklahoma has tornadoes. Um, we keep the roofers are. I mean, in the southeast, the roofers are making tons of money. That's for sure. Many insurers rather have cut coverage of wind and hail damage by increasing the deductible, or the first part of the claim the policy holder has to pay 1 to 2% more. Okay, so you've got a lot of wind like Oklahoma, and some of those southwestern, middle western states where you've got a lot of this wind damage happening. Companies are pulling back from Florida, Louisiana, both which have suffered tens of billions of dollars in losses from hurricanes in recent years. In wildfire-prone California, where State Farm and Allstate, two huge names, they've stopped writing new home policies. The industry says regulatory curbs on pricing means they cannot charge enough to cover their costs. Talking about California insurance regulator says insurance has failed to ask for adequate rate increases. So they're playing the blame game, okay? In Florida, alongside coverage restrictions and higher premiums, there's a reluctance from insurers to write policies for older homes or homes that don't have strong wind mitigation. That's the other thing, right? We're in a place where we need more inventory, and it's becoming harder to insure the older product in some of these communities. I mean, if you're shopping in Florida and South Florida specifically, I would never advise any buyer to buy something that starts with a 1999 or I would never advise anybody to buy 1999 or older in Florida. Okay, maybe there's an agent here that disagrees with that. I would only buy 2000 and older. That's kind of like a rule of thumb, that you're going to have a better standard of construction when it relates to. I'm not saying there's all bad construction older, but when it relates to the hurricane requirements of the build with the insurance companies. So newer is better, and we're not building enough newer. Affordable, of course. Higher premiums hit consumers already burdened with higher interest rates and inflation and low inventory and all of it. There is little chance that the home insurance pain will ease in the short term for either companies or policyholders, industry insiders and analysts say. I've put this one here down below as well for you in the BAMX daily download. All you got to do is sign up for BAMX. You get access to all of the hot sheet daily downloads. Severe weather events and insurance industry losses for the first half of the year, 2010, 2023. Below average for events and losses, below average for events, above average for losses. And then you've got above average for events, below average for losses, and above average for events and losses. And that's where the majority of the dots are those above average categories over there to the right. Severe weather events are happening more often, and causing greater losses. In the 2000s, the average year was 40 billion a year in losses. The 2010s, the average was 54 billion. And so far in the first 3 years of the 2020s, it's 90 billion. So quite a bit in the first 3 year of the 2020s. We'll see if that evens out over the decade. Depends on obviously the weather and some of these storms that we might experience this year. Who knows? Hopefully not a big year in storms. I went through escaped Naples last year, went over to Miami when Ian came through. That was catastrophic for a lot of the Southwest communities in Florida. Still, some areas are still recovering from that. Hate to see another one, but there are definitely more people living in those hurricane prone areas. So when one of those come through, the damage is significant. If you could blow that up so I could see that, Haley. Move to the motherload, Brad. Yes, California has a restriction on private insurance companies from raising prices more than 5% in a calendar year. So that's why California was at the 5% when we looked at the chart, because of that regulation. They want to increase obviously more. So since there's so many losses, so it's a mess what's happening in California. They've got, on one hand, the state's like, hey, let's protect the residents here from dramatic increases on insurance. Obviously, home values are amongst the highest in the country. So if we can save a little bit of money on insurance, be a good thing. So they got a cap on it. But then you've got insurance companies like State, I think it was State, it was Allstate and Farmers. Which two was it? It was two big ones in here that have stopped writing in California altogether. Okay. I mentioned them earlier, but I think it was Allstate and Farmers that have left California altogether. And so there might have to be an adjustment there. If you lose too many insurers, you're not going to have insurance, or insurance could get so high, or you might get less for your insurance. You just might not have a better product, right? Obviously, it can't go that high with the cap, but it's gonna create less options for homeowners. And we know anytime you have less options, that's not good for consumers. So insurance continuing to be an issue, and these are all the issues that home buyers are facing right now. First-time home buyers need to earn $64,500 to afford a typical starter home. This is just released in Housing Wire. Home buyer in San Francisco must earn $241,200 to afford the typical starter home. Now, San Francisco is not the typical starter home market, so okay, great. But $64,500 a year is the typical U.S. starter home. That's up 13% from a year ago, according from a new report from Redfin. In June, the typical starter home sold for a record $243,000, up 2.1% from a year earlier. Let me know in the comments what you can get for $243,000 in your market. This is up more than 45% from before the pandemic. And new listings of starter homes dropped 23% from a year earlier in June. It's the biggest drop since the start of the pandemic. Meanwhile, the total number of starter homes on the market is down 15%. Also, the biggest drop since the panty. The cost of financing, a median price U.S. home, assuming a 20% down payment, rose 12.4% from June 22. A lot of that obviously has to do with rents. And this is, listen, all of these things, we'll look at some locations here, but all of these combined, okay, it's like the interest rates, rising insurance costs, property taxes across most towns have either gone up in America in the last 12 months due to the prices going up or are about to go up. Okay. Property taxes have in some places you can get homesteaded, like my property in Florida. Not a big deal. I'm homesteaded there. There's a cap similar to, I guess, the insurance in California, which makes it very reasonable. But other places, it can just get out of control due to assessments. Jennifer and Michelle, MKE Real Estate in Azuki. I know I butchered that. I have to have butchered that county. 3-bed, 1-bath, needs a lot of work, around 1,100 square foot. So that's what you get for 240. Florida Keys, Taylor says you get a mobile home. It's a fixer upper on top of that. But then Dawn in Kaufman County, Texas, she gets a new construction for almost 1,300 square feet for that price on about a quarter of an acre. So different markets there, right? You get a mobile home in the Keys, Kaufman County, Texas. You get brand new construction, and I'm assuming, Dawn, is that like hurricane wind compliant for the insurance company since it's brand new? You typically don't build Texas and Florida if it's not going to be up to the current standards. Byron, San Francisco again would have to earn $240,000. So the whole cost of a starter home for that particular market to afford a starter home in that market. Austin buyers must earn $92,000, down 3.3% from a year ago. In Phoenix, a buyer must earn $86,000, down from 1% for the starter home in that market. Florida is the state where the income necessary to buy a starter home has risen the most. Okay. The buyers need to earn $58,000 per year to purchase a $220,000 home, which is up 28% from a year earlier. Still well below some of those other communities. That's why you continue to see migration inbound into Florida, because in comparison to some of those other places, it's still very affordable. Miami, you need to earn almost 80,000. Miami is becoming on the other end unaffordable, up 24.8% to afford the typical $300,000 starter home. Third is New York, New Jersey. Buyers need $88,800, up 2.11% to afford a $335,000 home. Okay, so Fort Lauderdale coming in, I guess, the most reasonable there, 58,300. That's below the national average. And then you've got some places where they've dropped, and that's down below at the bottom of the article. That'll be linked up in BAMX, which you can get all of the daily downloads. The affordability issue continues to be the one that I worry the most about in this market when it comes to residential housing. I get bigger worries on the commercial buildings and the office space than that, but it's Monday and there's a lot of good things happening, and certainly an opportunity with the unaffordability to have conversations with your clients. Do you envision in the future insurance going up or down in the future? I think we all can envision it going up. With the lack of inventory and the amount of inventory that's coming on right now, could we envision that home prices are going to go up or down, right? If everything is going to go up, then you start to educate people right now that, hey, maybe the interest rate is not what I should base my decision off of. If home prices are going to be more in the future, if insurance is going to be more in the future, if all the costs are going to be more in the future, maybe making that move now when I'm holding something of such value. Maybe it's the starter home and I need to move up, but I'm just concerned about losing my 30-year fixed interest rate, right? Because 9 out of 10 plus have an interest rate under 6%. Well, there's so few starter homes in the market. We just went through the numbers, how few of them there are right now. Maybe I actually get somebody to overpay in this market for that. I go and buy the move up home at a lower cost of what it's going to be tomorrow. Tomorrow meaning 3-5 years out, because I know these prices are under the next peak. And these are the conversations that real estate agents should be having with their consumers, because we know what's gonna happen over time here. And if you wait too long, you might be more disappointed, depending on what your goals are and how long you're going to stay in a community, of course, as a consumer. 10-year today is hovering around 3.95. It's kind of where it's been until we get more inflation data. I don't see this really moving, which means I don't see the 30-year fix really moving off of 7. Ended the week on the daily survey at 7.05 after having a high Thursday at 7.12. The Freddie Mac 30-year fixed weekly comes in at 6.81. All right, so there we are on those updates. The market opened up today green across the board, Dow, S&P, and NASDAQ. And we'll continue to just kind of await more data and what's going on with the economy. Don't wait too long if you're a BAMX member, though, to sign up for our Naples BAM camp on September 20th. We've released the link in the BAMX community. We're going to keep it there again for today. I think we release it on Friday late in the day. Thank you for those of you that are already signing up. It'll be available just to BAMX members first. There's limited seating on BAMCamp. You can see all the speakers on that list. And then I think tomorrow at some point it'll go public. Okay. So if you're not a BAMX member, you get 25% off the lowest discounted price. So you get 25% off your ticket price by being a BAMX member. So sign up for BAMX today. Go get your ticket to BAMCamp. It's going to be an unbelievable event, September 20th, the best speaker list probably ever seen when it comes to knowledge broker stuff and becoming a great marketer in your space and being able to build your brand. So check out BAMCamp in September. BAMX, it's available right now only to BAMX members, and you get the massive discount being a BAMX member. You've got a link for BAMX down below, and from there, you'll get access into the private group where you can see the BAMCamp link. Also, if you're going to be in Texas in August 22nd and 24th at the Tom Ferry Summit, make sure you come to BAM Bash. We've got the link for that available for all BAMX members as well. And if you don't have your ticket to Tom Ferry Summit, you can do so down below by using code PRBAMSS to get $100 off of that ticket. I will be there as I am every year. And of course, I'll be at the BAM Bash night 1. Hope everybody has a great Monday, productive start to the week. We'll see you back here tomorrow at 9:30 in the East, 6:30 in the West. Until then, toodaloo.